Enron reported more than $1 billion in earnings from hedges that transferred almost no real economic risk. The companies standing on the other side of those hedges were funded largely with Enron's own stock. Years later, the Supreme Court ruled that one legal theory used against Enron chief executive Jeffrey Skilling was invalid. Yet his conviction survived because another court found overwhelming evidence that he had conspired to commit securities fraud. So where did aggressive accounting end and criminal deception begin? Enron did not fool Wall Street with one imaginary invoice or one secret bank account. It built a system in which future hopes became present profits. Losses moved out of sight, and borrowed money resembled operating cash. Each step had accounting language, legal paperwork, and professional advisors standing nearby. That was precisely what made the deception durable. The central legal question was not whether Enron used complicated accounting. Complicated accounting is not a crime, although it occasionally behaves like it has something to hide. Prosecutors had to prove that executives knowingly used those methods to make materially false statements to investors. Enron's first essential tool was mark-to-market accounting. Instead of recording profit as a long-term contract produced actual revenue, Enron estimated the contract's total future value immediately. If a project was expected to earn $100 million over 10 years, much of that projected profit could appear at once. The method was permitted for certain trading activities and was not inherently fraudulent. The danger was that the reported profit depended on assumptions about prices, costs, demand, and performance many years away. A small change in those assumptions could turn a triumph into a loss, without changing a single physical asset. Enron therefore gained an unusual power over its own earnings. It could select optimistic models today and leave tomorrow's employees to explain why reality had become uncooperative. This created a second problem. Once Enron booked years of projected profit, the company needed new deals merely to keep reported earnings growing. Internal budgets increasingly began with what analysts expected Enron to earn, rather than what its businesses could realistically produce. Executives called the resulting shortfall the gap, the stretch, or the overview. The vocabulary was gentle. The financial pressure was not. When a business missed its target, Enron could not simply admit that an earlier estimate had been too optimistic. A visible loss might damage the stock price, credit rating, and confidence supporting the entire structure. Enron's solution was often to move the troubled asset or its apparent risk into a special purpose entity. These entities were separate legal structures commonly used for financing, asset sales, and risk management. They were not illegal either, but accounting rules required genuine independence, including outside equity at risk and control by someone other than Enron. Without that independence, Enron should have consolidated the entity and shown its debts and losses on Enron's own statements. Chief Financial Officer Andrew Fasto managed partnerships called LJM1 and LJM2 while still serving Enron. Enron's board approved the conflict under limited conditions, expecting oversight and fair dealing. In practice, Fastow could negotiate for Enron on one side and for his private partnerships on the other. That arrangement did not merely invite conflict, it sent the conflict a calendar invitation. The most revealing structures were the Raptors, entities presented as hedges against declines in Enron investments. A real hedge transfers risk to a counterparty capable of absorbing the loss. The Raptors were funded mainly through Enron stock and promises tied to Enron stock. If Enron's investments fell while its own stock remained strong, the structures might appear to work. If Enron stock also fell, the supposed protection weakened exactly when Enron needed it. Enron's own board materials warned that the arrangement transferred profit and loss volatility without transferring economic risk. The Powers investigation later described the company as effectively hedging with itself. Through those transactions, Enron reported more than $1 billion in earnings over roughly 15 months. The Powers report found that figure represented more than 70% of Enron's reported earnings during that period. This was not just an accounting footnote. It meant that much of the profit supporting Enron's public image depended on counterparties whose capacity depended on Enron itself. Prosecutors also focused on individual transactions, showing how paper form could conceal economic reality. In the Cuyaba Power Project, Enron sold an interest to an LJM partnership near a reporting deadline. A hidden understanding protected the partnership from loss and contemplated Enron buying the interest back. The transaction allowed Enron to recognize roughly $65 million of income while the project remained economically troubled. In the Nigerian barge transaction, Merrill Lynch acquired an interest shortly before year-end. Evidence showed Enron secretly promised that Merrill would be taken out of the investment with a profit. Enron nevertheless treated the deal as a sale and recorded about $12 million in earnings and $28 million in cash flow. The paperwork said Risk had moved. The side agreement said Risk had merely taken a short vacation. Another document, known as Global Galactic, memorialized hidden commitments concerning several transactions. Prosecutors used those side deals to argue that supposedly independent sales were never independent at all. Enron also used transactions called prepays to address a different weakness: cash flow. Investors could debate estimated profits, but cash from normal operations looked reassuringly concrete. Enron obtained billions through financing arrangements that functioned economically like loans. It then reported much of the resulting cash as operating cash flow rather than financing cash flow. By April 2001, the Securities and Exchange Commission alleged that Enron had about $3.9 billion in undisclosed prepays. The debt did not disappear. It simply arrived wearing the name tag of ordinary business activity. Skilling's strongest defense began with the fact the prosecution could not honestly deny Enron's accounting was extraordinarily complex. Major accounting firms reviewed its statements. Lawyers advised on transactions, and the board approved many structures. Skilling argued that business failure, aggressive estimates, and reliance on professionals did not prove criminal intent. His lawyers attacked Fasto and other cooperating witnesses as participants seeking reduced punishment. They also argued that allegedly false statements were either accurate, immaterial, or expressions of business optimism. That defense mattered because securities fraud requires more than showing that investors lost money after executives made confident predictions. Prosecutors had to connect Skilling personally to intentional misrepresentations about facts important to investors. They presented evidence that Enron shifted hundreds of millions in losses from its retail energy unit into its wholesale division. The transfers helped preserve the appearance that the retail business was succeeding. Evidence also showed that Enron described its wholesale operation as a stable logistics business, while it carried substantial trading risk. Its broadband business lost money quarter after quarter, yet executives promoted it as a major source of future value. The government's case was therefore not that every estimate proved wrong. It was that executives knew important descriptions of Enron's current condition were false when they gave them. In October 2001, the structure began admitting what the public statements had concealed. Enron announced a $544 million after-tax charge connected to the Raptor transactions. It also reduced shareholder equity by about $1.2 billion. Weeks later, Enron said it would restate financial results going back to 1997 because several partnerships should have been consolidated. The restatement erased reported income and added debt. Credit confidence collapsed. Trading partners demanded protection, and Enron filed for bankruptcy in December 2001. The collapse harmed employees, retirees, shareholders, and counterparties, whose losses were real even when the profits had not been. Fasto pleaded guilty to 2 conspiracy counts and admitted participating in schemes to manipulate Enron's financial statements. He agreed to cooperate, forfeited more than $20 million, and ultimately received a 6-year prison sentence. The government then tried Skilling and former chairman Kenneth Lay together in Houston. Prosecutors alleged that senior executives had maintained the appearance of predictable growth, adequate cash flow, successful business units, and manageable debt. Skilling faced conspiracy, securities fraud, false statement, wire fraud, and insider trading charges. The jury convicted him on 19 counts: conspiracy, 12 securities fraud counts, 5 false statements to auditors, and 1 insider trading count. It acquitted him on 9 other insider trading counts. An important reminder that the verdict was not a blanket endorsement of every accusation. Lay was convicted on all 6 counts in the Enron jury trial and separately on 4 bank-related counts before the judge. He died before sentencing, so the court vacated his convictions and dismissed the indictment. That procedural result left no final criminal judgment against Lay. It did not establish that the underlying evidence was false. Skilling originally received a sentence of 24 years and 4 months, 3 years of supervised release, and $45 million in restitution. His appeal then produced the case's most misunderstood legal development. The prosecution had told jurors they could convict on an honest services fraud theory. In 2010, the Supreme Court ruled that the honest services statute covers bribery and kickback schemes, not every undisclosed breach of loyalty. Skilling's conduct did not involve bribes or kickbacks, so that theory should not have gone to the jury. The Supreme Court did not declare him innocent or erase the remaining fraud evidence. It sent the case back to determine whether the invalid instruction had affected the verdict. The Fifth Circuit concluded that the error was harmless beyond a reasonable doubt. It found overwhelming evidence that Skilling had conspired to commit securities fraud independently of the invalid honest services theory. The court, therefore, affirmed every conviction. It did, however, vacate his sentence because the trial court had incorrectly applied an enhancement involving financial institutions. Enron's employee retirement plans did not qualify as financial institutions under that sentencing rule. In 2013, Skilling was sentenced to 14 years after an agreement that ended further appeals. About $42 million from his assets was applied toward restitution for victims. He was released from federal custody in February 2019. In a separate civil case, the SEC obtained a permanent injunction and a lifetime bar preventing him from serving as a public company officer or director. Enron also became part of the political force behind the Sarbanes-Oxley Act of 2002. Alongside WorldCom and other accounting scandals. That law created the Public Company Accounting Oversight Board and strengthened audit committee, internal control, and auditor independence requirements. The prosecutions did not establish that mark-to-market accounting, special purpose entities, or every failed Enron project was criminal. They established that lawful tools become fraud when executives use hidden guarantees, sham independence, manipulated assumptions, and false statements to mislead investors. The Supreme Court's ruling narrowed honest services fraud, but it did not erase Skilling's responsibility for securities fraud. Wall Street was fooled because Enron converted forecasts into earnings, debt into operating cash, and self-funded promises into apparent protection. Enron crossed the legal line not because its profits depended on the future, but because the people reporting them concealed who still carried the risk.